Okay, so a warm welcome to everyone for the next in the Tutors Association's summer sessions series. We're really pleased to be joined by Aiden Corcoran working with Go Simple Tax to discuss the benefits and merits between being a sole trader and being a limited company. I know this is a question we get a lot from a lot of different tutors. At what point, if at all, should they switch from being a sole trader to a limited company? Should they do it at the beginning? So it's very topical. We are recording the session so that people can catch up after the event if they've been unable to make the session live. And I'm going to pass over to Aiden to take it away and deliver it for us, please. Thanks very much, Aiden. Really pleased to have you here. Really pleased to be working with Go Simple Tax and really looking forward to it.
Perfect. Thank you very much. As I've just been introduced, my name's Aiden. I work for Go Simple Tax, and today's presentation will be on sole traders versus limited companies. So in regards to that, what we'll be looking at? Well, we'll be looking at these following points. So we'll be looking at income tax rates and thresholds, corporation tax rates and thresholds, the pros and cons of both. We'll do a little comparison between the two for certain income ranges. If there are any other questions or any different incomes / profits, should I say, then be sure to get involved and pop something in the chat, and I can have a quick look for you on the comparisons between those later on. And then we'll also look at the pros and cons of a sole trader, and then we'll go into a little Q&A session, time permitted, but from experience, I would say that there'll be plenty of time for questions if there are any questions. So no need to worry that we need to be rushing those in. So first of all, we'll take a look at the income tax rates. So these apply for England and Wales. Scotland is different, and I have not included them on this spreadsheet, but PowerPoint. But if you have any questions about Scottish rates, I can send over a little document following this presentation if you need those. So first of all, let's just look at the tax rates and then the tax bands. So looking at these have been fixed for the last few years in terms of the actual rates, with the basic rate at 20%, higher rate at 40%, and the additional rates at 45%. Obviously, prior to that, you have a personal allowance, which is at 0%. And that has been also frozen for the year 24-25 at 12,570. So that is basically what rates of tax you'll pay if you were self-employed through a sole trader. The thresholds, as you can see on the screen, a little bit confusing with all the numbers in there, but let's just talk it out, and hopefully by hearing that it might make a little bit more sense. But for the personal allowance, for the first £0 to 12,570, you will receive tax-free. Following that, the next pound up to 50,270 will be at the basic rate. So cross-referencing that to the other side of the screen will be at 20%. You'll have the higher rate then following the £50,270 all the way up to 125,140. That will be at the 40% rate, and then anything over that will be at the additional rate of 45%. Basically, last year, this was higher, so the additional rate last year was actually up to 150,000, but there was a change from April, and that means that more people will fall into that additional tax rate for this tax year and potentially beyond. Obviously, we've had a change of government since then, and Labour are known for changing the additional rate and higher rates in the past. So there may be changes, but for this tax year, at this moment in time, everything seems to be staying the same, as that's what they promised in their manifesto. So let's hope that this information stays relevant for the remainder of the tax year, and it doesn't change a week later once we've all got this stuck into our brains. So that would be for sole traders. So what else would you have to pay? You'd also have to pay national insurance. So let's look at the national insurance rates, and then let's look at the thresholds. So the rates for national insurance, you've got two different rates. You've basically got a class 2 rate, which is based on a weekly amount. And then you've got class 4, which if you are self-employed already, you would have seen this being added to your tax bill. once you reach a certain amount. So what amount is that? So first of all, class 2 for this year, if you are below the £6,725 profit range, then you could voluntarily apply to pay this class 2, and class 2 basically goes towards your benefits and your state pension. So as you go along, you'll need X amount of stamps against your NIC record, which is where the class 2 comes in. So making sure that you've got those or enough of those, so when you do reach state pension age, you get the full amount, albeit it's a long way away probably for a lot of years, but it is worth planning well ahead on that one, because I believe you need 30 years at least to get that full amount. So definitely some planning involved there. Moving on to class 4, and you've got two different rates. You've got a 6% and a 2%. And when do those apply? Well, they pretty much align with the tax rates. So for the lower profits limit, you've got from the personal allowance up to the higher rate. So basically, as you're paying basic rate tax at 20%, you'll also be paying the lower profits limit at 6%. And then anything over that, once you get to that 50,270 plus, you'll be on a 2% rather than a 6%. So basically, on profits from over the personal allowance up to the basic rate, you'll be paying about 26%. So you can sort of plan your taxes around that, and then anything above the 50,270, you'll be paying at 42%. So just based off that sole year, you'll know roughly what to put away. That's not including payments on account, which we can touch on in questions later. But that then starts getting a little bit more of needs to save a bit more than that 42% or that 26%, as I've mentioned. So hopefully that gives you an idea of tax and national insurance as a sole trader. So let's move on to corporation tax rates. So change in the last couple of years have made it a little bit more complicated, because previously it was just all profits at 19%. However, I've got to say, a couple of years ago, the government basically introduced a main rate and a marginal rate. So the main rate was applied to anything over 250,000. The small profits rate was anything up to a 50,000, and then in between that 50,000 to 250,000, there was a worked out marginal rate of 26.5%. So in terms of, or in relation to the sole trader rates, you're looking at those and thinking, oh yeah, it's a little bit less, so surely you would think that would be better. So we'll come to that a little bit later on when we're looking at the comparisons. But basically, when it was a 19% flat rate, it was much better to be, or well, not much better, but depending on your profits, it was definitely better or more efficient to be a limited company. However, with these changes of the marginal rate and the main rate getting introduced, you'd basically lowering the gap or making the gap smaller between the sole trade and limited company differences, as we will see. And you may actually be surprised when we come to the comparisons how little the change is these days, given the scenarios that I have put down. So looking at those, that is the tax rates for the limited company. You would also, if you are taking out more than just a salary, you'll have dividend tax rates. So dividend tax rates, again, in the last 10 years have changed quite drastically. Previously, you would have a dividend and you would get a tax credit automatically. The tax credit then got dumped and we got what we called as a dividend allowance, which is a 0% amount of dividends, which did start at £5,000. And as you can see from my little note at the bottom there, it's gone all the way down to £500 for the 24-25 tax year. So over the last, I think it's 6 or 7 years, we've seen that go from 5,000 to 2,000. It stayed at 2,000 for a few years, and then it's been halving for the last couple of years. So once again, that is another factor at why sole trade and limited company tax bills are getting a lot closer, because previously you could have a lot more at 0%. Usually, if you're a limited company, you would structure your finances to be whatever your profit is. You would then take a director's salary, usually, or it used to be up to the lower profits limit, but in recent years, it was actually more beneficial to go up to the personal allowance. So you take a £12,570 salary through payroll from your limited company, and then anything in excess of that, you would usually take dividends. So as you can see on the screen here, the dividend rates are 8.75%, 33.75%, and 39.35% for basic rate, higher rate, and additional rates respectively. With again the thresholds following the exact same as the income tax thresholds. So hopefully that does align things to make things a lot easier when you're trying to work out which rate you're meant to be paying. But it is additional tax that you need to think about when taking money out of a limited company. So just to recap, as a sole trader, you've got tax and national insurance due on your profits. And as a corporate or corporation limited company, you would have corporation tax due on profits. You would have then anything that you take from the company personally. You would have income tax if you go over the personal allowance, and or dividend tax on any dividends that you do take out. So there's two taxes, or tax and an I for sole traders, and then for limited companies and you as an individual, you would have technically three taxes and potentially an I for both the limited company and the individual yourself as well. So a lot more complex when it comes to limited companies, and I will mention that when we come to the comparisons a little bit later on with the pros and cons. So what else do we need to be aware of? Well, capital gains tax. Basically, as you are a separate entity, when you create a limited company, you will have completely separate assets in comparison to what you would do as a sole trader. As a sole trader, everything is yours and it's all in your estate, whereas with a limited company, you are basically separating yourself from the business. So the business is its own separate thing, and you are your own person. So basically, if you have a load of money from multiple successful years trading, then at some point you will need to sell up, and you need to extract that money from the company, and capital gains tax may be relevant for yourself. So again, let's have a look at the thresholds. Basic rate is up to the 37,700, which is basically from the personal allowance up to the basic rate. So whatever you've got left of your basic rate threshold in income tax, you would then top it up with whatever your gain is for your capital gains tax. If that goes over the higher rate threshold, then you'll go into the additional rate. What are those rates? Well, basic rate 10% and the higher rate 20%. There's no additional rate for capital gains tax, it only continues with that 20%. However, if you are selling assets as well as selling residential property in the same year, then we'd be looking at basic rate and higher rate of 18 and 28%. Just having a look there at the tax exemption. So you've got personal tax exemption, which was 12,570. You have a dividend allowance of 500 for the year, and for this year you'll also have a capital gains tax exemption of £3,000. Again, this has been reduced in the last couple of years. It's actually halved for the last 2 years. So now it is only £3,000. Previously, it was around about £12,000. So you can see here that there's a lot more gains coming into the tax system for you to pay tax on, which is quite annoying, quite unfortunate. But if you're making those gains above the £3,000, then tax does have to be paid. Hopefully that gives you a overview of what tax is due for a sole trader and what tax would be due depending on what income and what gains you have for a person, as well as being a limited company. So let's just move on now and look at pros and cons. So I'm just going to take a breather, take a quick sip, and then we'll crack on with pros and cons of a limited company to begin with. So I'm going to adapt on these points as they go along if they need adapting, and I may add in a little bit more improv as we go along. But looking at the pros list to begin with, you'll notice that what is on the pros list is basically the opposite of the cons list. And then when we go to the sole trade pros and cons, it's literally going to be the opposite again, because what is a pro for one is obviously a con for the other, and vice versa. So can't get too creative with the pros and cons, but it'll give you a view from both sides, which if you don't understand one side, you probably will understand the other side. So why is it pros, or what are the pros of a limited company? Well, first of all, better tax planning opportunities. As a sole trader, you would be taxable on all profits for the year. Any sales that you've also done during the year would be subject to capital gains tax, but that is everything and anything that you've done will be taxed. Whereas as a limited company, as a person, you will only be taxed from what you withdraw from the company. So basically, as you as a person, if you were to make £100,000 profit, then you would be taxed as a sole trader on £100,000. If your limited company made £100,000, but you only took £30,000 out of the company, you as a person would only be taxed on £30,000. So basically, for tax planning opportunities for yourself, you're only being taxed on £30,000 rather than £100,000, and therefore you personally would have a lower tax bill from good tax planning. If you wanted to take that money later in a different year, you would be taxing it again, but it would be for this sole year we're looking at, there are definitely better tax planning opportunities. If you don't need the full £100,000, why are you being taxed on it? Could be an argument there. And also in regards to succession, so if you have a different business, I mean, Tutors is sort of like a sole person, isn't it? But if you, let's say, expanded and had lots of tutors underneath you, and you had a huge business model, then succession, you could, if you were a sole trade, then you are that business and there's lots of people behind you, underneath you, sorry, and it's quite fudgy to get somebody to overtake you later on in life. Whereas succession planning, as a limited company, you've got shares of which basically owns that company, and you can pass those shares along as you are looking to retire or looking to sell up. So the planning is much better for a limited company. Protect the name of the company. When you register with Companies House, you claim a name, and then that is your name. Nobody can have the exact same name as you. And also, if you feel like there's a company out there that's sort of living off your brand, then you can dispute that at the point of their creation. You should get a notification saying, let's say, for example, I've got, I don't know, Aiden Sports, and someone's put like Aiden Sports with an S on the end of Aiden's, then I should get a notification for that, and I can say, oh, actually, it's quite close to my brand. I don't want somebody that close to my brand. They'll need to choose another name, and then they'll get a prompt saying it's not been approved. So you can protect the name of your company if you've got a specific brand or specific name that you want to have. One thing for yourself, like I say there, moving towards retirement, you can include any direct pension contributions from the company straight into you as a person, your pension pot, and that would be fully tax deductible from the limited company, which is a great benefit. You do receive tax relief as an individual, but in terms of this, it does work out a little bit better in terms of planning when making pension contributions directly from the limited company directly into a pension pot, as it's 100% relief. And then another pro of a limited company is you may be seen as more professional. If you've got, I don't know, let's choose a building company because we can do that. So let's say we've got T&J Building Company Limited, or you've got Tony and Jerry. What sounds more professional when they're coming to do some work? The whole big business that sounds like it's corporate, massive, or just two lads that turn up with the ladders in the van? So it's perception on how you do see that, because obviously you're contacting a big company, but these two same people will turn up with that ladder in a van. whereas as a sole trader, they've only got that name of T&J company, T&J building, sorry. So it's perception in terms of a pro there, but you'll be surprised at how many people trust the fact of a limited company being there rather than just the guy from down the road on that. So moving on to a few cons. So there's a lot more admin, like I said before, in terms of the tax and NI side of things. With limited companies, you've got the company finances to sort out yourself, and then you also need to extract that money from the company and then deal with your own personal side of things as well. So the admin is definitely a lot higher. There's less privacy, as your information is actually available publicly on Companies House, and any changes are reported as you go along. So if you do create T&J Building Company Limited, or whatever you want to call it, then you can click into that, click onto people, and your full name will be on there, and whatever address you currently live at, or if you nominate a different address, you can do, but that address will be public viewing. So just need to be aware of that. Tax due is less competitive these days with the new corporation tax rates, C-tax rates. Like I said there, all your 0% allowances are reducing or have been reducing over the last few years with the new structure of corporation tax as well, with the new 26.5% marginal rate up into the 25% rate after that. It is a lot less competitive in regards to the limited company being more beneficial, as we'll see on the comparisons in a couple of slides' time. Also, for those that do use things privately that you do for your business, then there could be, or there are, more complications with using those sort of things with BICs, which is benefit in kind. So if, for example, you were to use your car personally and you did a little bit of traveling around, if you're going to schools or people's houses, then the use of your car as a sole trader would be include 100% of the costs, and then private adjust for what you use personally. So let's say, for example, you do 10,000 miles during the year, and it's exactly split down the middle, 5,000 miles personal, 5,000 miles business, then include all the expenses and then just half what is actually allowable in your accounts. Whereas with a limited company, you'd have the company owning the car, and then you would have all the expenses going through there. However, if you are using that car personally, then you would then have a benefit in kind for a company car, which, depending on what the emissions are and depending whether you pay for your own fuel for your private journeys or you don't, it can quite add up just for a normal standard car. If you choose an electric, then it can be quite a bit cheaper. But in terms of for the everyday car that everybody has, let's say they've got a Ford Focus or a Volkswagen Golf, something like that of a mid-range car, then you can be looking at like a few grand, if not more, £1,000 worth of tax charges for the use of that car throughout the year. As I say, it goes completely off the CO2 emissions on the brand new value of the car, regardless of how long you've had it for. So that can be quite costly. That is the pros and cons of a limited company in short. Let's move it to the sole trade, and you'll see, like I said before, that they are basically a list of the opposites what were on the previous page. So what are the pros of the sole trade? Well, it's easy to set up. You literally just say, okay, I'm going to start a sole trade today, and you're officially there. All you need to do then is, after the first tax year, you would then contact HMRC and say, I started trading in November last year. Can you give me a UTR? And from that, you will then have the deadline from for the 31st of January following the end of the tax year. That is how easy it is to set up as a sole trader. Less admin involved. You will still need to keep records of your income and outgoings, but you don't need to do the whole corporation tax return as well as your own personal tax return. You don't need to track the 5 different taxes and NICs. You've only got the two. You also don't need to keep as many records and worry about falling into different traps that a limited company does have. More privacy. Doesn't need to be anywhere at all online unless you're advertising it yourself. You've got your own website and it's got your personal details on there. That's the only place they're going to be. There's no person's record or person's house in regards to the company's house where your details are stored. Obviously, HMRC have your details, but in terms of public viewing, they are quite out of the question unless you want them out there with advertising, etc. Easily change business structure. There's no way, or there's no real stop if you were to say, right, okay, it's just me at the moment and I want to introduce my sister, my brother, my friend into the business and they can own the business with me together. You would just simply go from a sole trader then to a partnership and it just flows. Whereas if you were to go from a sole trader to a limited company, you would cease as a sole trader, you would go through into a limited company and then that would start trading. And then you've got the 2 periods there where you've got to report yourself as a sole trader. And then you've also got the limited company and that new accounting year as well. So there's definitely ease to change between a sole trader to a partnership rather than a sole trader to a limited company or within a limited company. If you wanted to add people in and change people, you have to start looking at moving shares, and usually moving shares means there is a disposal of shares for the person who had the shares, and then there would be capital gains tax potentially for that person in there. So like I say, it is a little bit more complex when looking at the structures. Losses used against other income. This is a very good one if you were in a industry where you aren't guaranteed to make a profit in the first year or even the second year, Joe, where you've got to build yourself up, you've got to spend lots on advertising, lots of materials, etc. The benefits of a sole trade is you can actually use losses against your other income. Or if you've not got any other income during those 2 years and you're just living off savings, then you can carry it back and get some tax back from a previous tax year if you've paid tax. Whereas as a limited company, like I said before, you are a separate entity, and therefore being that separate entity, you can't carry the losses from the company to you as a person. So one tax planning thing that I used to suggest when I was in practice was to always start out as a sole trader until you're getting into those beneficial profit margins, where you then go, okay, I'm not going to make a loss now, so I'm not going to benefit off that rule. So you might as well go into a limited company and gain the benefits from what were previously within that limited company. But as I say, if you're looking for tax benefits, it might not be as effective, as we'll come to shortly. On with the next point, should I say. So tax due is now more competitive, as in it's more competitive between the two. Previously, like I say, you could have been at a point where you were saving £4,000 or £5,000 in tax and NI by going from a limited company, whereas these days it's not that much. It really isn't that much, especially when you're talking less than the VAT threshold of £90,000. It's very, very close. So it is worthwhile listening to those comparisons shortly. Hopefully that gives you a brief or in-depth look of pros for a sole trader. What are the cons? Oh, figure happy then. So cons, what is it? So debt liability, like I said to you before, in terms of debt liability, you've got everything that is taxed as it comes, as you have profit at the end of the year or in the accounting period, and therefore it could be a high bill when you're not actually using all the money. Hopefully you've got all that money spare because you have a bigger tax bill to pay. But if you spent it because you've just seen it as your money as you've gone throughout the year and you've not actually planned for a tax bill, it could get you in a little bit of a mess. Also, debt liability is you're not protected, or your personal assets are not protected unless you have some sort of insurance. Obviously, you would always look at insurance for having a business, but if you didn't and you weren't aware of that and you've gone somewhere and someone's got injured, or you've done something and somebody goes, okay, I'm going to sue you because I feel like my life got worse or whatever it is, then your personal assets would be potentially at risk if you were a sole trade. Whereas a limited company, as I said to you before, you're a separate entity, so they will be then suing the limited company as an entity, not you as a person, and therefore whatever's in the company would be at risk, but you and your personal belongings would not be at risk at that point. So that is definitely a con, but if you have different liability insurance, then that could be a way around that, to get rid of that con. Could be more difficult to get financing. Again, if you've just started a business and previously you've not been the best with money management, or previously something's gone wrong with you and you've got, I don't know, potentially bad credit score, CCJs, anything like that, then for you and that business, there could be some knock-on effects from that, from your history. In the opposite of that, limited companies start to have a new shell as you've created them. They won't be able to get finance at first, or they shouldn't be able to get finance first unless there's sort of like new company loans, but it's treated slightly separate from yourself. So you're probably more likely to get some financing through a limited company than you would be personally. Lack of flexibility with tax bill, I've just mentioned that everything is taxed, and then potentially not as appealing to customers as a limited company. Like I said before, if you've got this limited company business turning up at your house compared to just T&J, then it could be a different perspective sort of thing, and people may not want to go with the person down the road. They'd rather go with the well-established in inverted commas limited company. That's the details are on company's house if anything goes wrong, and you can go and argue and do whatever you need to do legally with that. So there is pros and cons of a sole trader. Hopefully that has been informative, albeit sort of regurgitating what I've said for limited companies, just vice versa. A little bit more detail in terms of perspective, but overall, hopefully it has given you a little bit of information on that. So let's have a look at comparisons. So looking at these comparisons, we've got a few points to make before we go into them. The graph takes profit figure before salary adjustments and tax and NI due. So when I went out on one of the axes, you'll have profits, and it'll be, I think I did 20, 30, 50, and 75, something like that. Those will be the profit figures that will be taxed as a sole trader, but those are the profit figures prior to adjusting for salary adjustments on a limited company. There is no way to make it fair. For a director, we are assuming, or a limited company, we are assuming that you are taking £12,570 during the tax year, because that is the most cost-effective salary for the tax year. Doesn't include any accountancy fees, because if I was to include accountancy fees, the limited company fees would usually be at least double, depending on the size of the company, I suppose, and who you go to for your accountant. But the fees would usually be at least double in my knowledge, and therefore haven't been included in the calculation. So when we go to the comparison, they're not included, but I will mention them and what I would expect the average accountancy fees to be, and therefore it will then put it into perspective again which one you should choose, or which one would be more beneficial for yourself. And here we are, we're looking at tax and NIC, and it's only relevant to the tax year. It doesn't include payments on account. Like I said, if you want to know about payments on account, be sure to ask a question a little bit later on, but it does that starts complicating the matter in terms of how much tax you need to put aside in your first year of trading if you go over X amount and all that. So it does complicate things, but if you are interested to know, then be sure to give me a shout on that one in the chat box. So looking at these, and it doesn't look as clear on the on the screen as it did prior, but we're looking at we can look at the numbers and we can see how close it actually is in regards to that. There's two lines here. There's a red line and there's a yellowy orange line, depending on which color you can see. But the numbers on the left hand side we've got for sole trader, and that is your net take home pay. So that is how much you are coming out with at the end of the year when you earn a certain amount. And then we've got on the right hand side the limited company. So along the bottom we've got 20,000, 30,000, 50,000 and 75,000. I'm pretty sure that's what I said a minute ago, so I'm happy with my memory there. And looking at that, we are looking then at what you take home after NICs and taxes based off, as a sole trader, getting that profit and being taxed and NI'd if applicable, and that's what you walk away with. As a limited company, that would be including your 12,570 salary plus whatever's left that you've taken out as dividends after dividend tax, after corporation tax, after NIC that may be applicable there. So from a £20,000 profit, you would come out with £18,068 as a sole trader, but you would come out with £17,751 if you were trading through a limited company. Again, for £30,000 profit after taxes, etc., you'll end up with £25,468, whereas as a limited company, it will be £25,142. £50,000 profit, you're paying just under £10,000 in tax, so you're coming out with £40,268. But as a limited company, you're paying just over £10,000 of tax and NI, so you're coming out with £39,925. So in those first three examples, 20, 30, £50,000 of profit, it's actually more beneficial to be a sole trader, as you're paying a few £100 less in taxes. However, once we start going up into the higher figures, once we start going into them higher rate tax bands, the shift starts to move, and we can see here then that £75,000, you would come out with £51,911 as a sole trader, but £52,254 through a limited company. So in this example here, we can see it's about £340 more in your pocket as a limited company. However, as I mentioned before, accountancy fees on the average person, I'm talking, I used to work for a top 100 firm, and for a sole trader, you're probably talking at like £400 to £800 for your accountancy bills, depending on how many transactions and how much you earn. As a limited company, it used to be a minimum of £1,500, and that could go up, depending on how much you earn. But for, let's say for someone on a 75,000, you're probably talking between £1,500 and £2,000. So from a 400 bill to a 1,500 bill, if you're talking the lower end of things, that's a £1,100 difference, which is an additional cost, which would slightly reduce your taxes due, but it would also decrease your net income by quite a bit. So this is where I said that previously you would look at a limited company and save £4,000 or £5,000 of tax, but you would have the additional cost of accountancy of, let's say, 1,500. So you'd be 3,500 quid better off. Whereas these days, it's literally too close to call, as you can see on the next slide. And therefore, it may actually be better to stay as a sole trader, provided that you're not in a high risk industry where you may be liable to people coming back at you for any wrongdoings or any injuries, etc. But on this screen here, you can see for the 20, 30, 50,000, we're in the positive. That is being more beneficial by about £340, £330 of tax being a sole trader for those profits. And as a 75,000, you'll be 340 quid better off as a limited company. So hopefully that gives you an idea of what structure you would have between the two. I feel like I have thrown a lot of information everyone's way. If you've got any questions from any of the previous slides, then be sure to stick that in the chat now, as we will just wind down completely and go into a Q&A. I can finally breathe. So hopefully you found that helpful. If you've got any questions now, let me see if I can get the questions up on my screen, if there are any questions. Doesn't look like it on my screen. Oh, there we go.
Thanks so much, Aiden. I think we've got one question from Sarah here.
Perfect.
Can you see it in the chat?
Yep.
So just for the benefit of recording as well, we should probably read out the question. So Sarah's question is, I have a tutoring business with a team of 12 tutors who are subcontracted. My accountant has recommended that I stay as a sole trader due to VAT, but I don't really understand this. Could you please explain? I wanted to consider switching to a limited company for personal asset protection. All my team members and I have professional indemnity and personal liability insurance. I think you probably mean public liability. But I'm still interested in the additional protection a limited company offers, and I'd love to know your thoughts.
So I'd need to know more detail. Yes, oops. I think I'd need to know more details about how much it's coming in, how much you're paying the other subcontractors, that sort of thing, before we can start talking about VAT. Albeit that is not my specialist subject, so there may be certain reasons why you would stay as a sole trader.
I can give a brief comment on the VAT situation. So the VAT situation for tuition companies. So for sole traders, any tuition delivered by a sole trader themselves is VAT exempt.
Right.
So therefore it doesn't incur any VAT. Doesn't matter what your turnover is going to be. Any tuition delivered by a limited company is VATable.
Right.
So
that would
above the VAT threshold. The VAT threshold at the moment is £90,000, I believe, Aiden, correct?
Yeah, £90,000 for this year. Yeah.
So if your turnover, if your tuition turnover is over £90,000 and it's going through a limited company, then you will be subject to VAT. That means all of the tuition, not just the tuition over £90,000, but £90,000 is the mandatory. Is where you have to, the registration for VAT is mandatory. So below £90,000, you don't have to register for that. It's optional. You can if you like.
Yep.
Above £90,000, obviously VAT registration is mandatory. I believe that applies if you're. It would apply if you're a sole trader if it wasn't exempt. If you're doing non-exempt trading,
Exactly.
Is that correct, Aiden? Yeah,
that's exactly correct. Yeah.
But obviously, where we're talking about tutors, professional tuition, private tuition is VAT exempt. So it doesn't matter how much money you earn from private tuition, you never have to apply VAT. You never have to register for VAT. If you're a limited company and you're earning above the £90,000, then you do have to register for VAT, and you do have to pay charge clients VAT on all of the tuition you deliver. It doesn't matter if you deliver it personally yourself. So what sometimes people do is they deliver the tuition, any tuition they deliver as a sole trader. And then if they've got other tutors working for them, that goes through the limited company. Now, again, that only works to sort of keep your own only protects VAT from your own tuition. If your tutors then between them end up with a turnover over £90,000, you will still have to register. The other what then people can do is they can consider going into running an employment agency rather than an employment business. We won't have to go into all the details of that here, but that basically tries to limit the VAT liability to the commission that you get rather than the amount of money that's also then being paid to the tutor. So that's the VAT situation. So yeah, I mean, from a VAT perspective, if you're going to earn over £90,000, it does make sense perhaps to be a sole trader, because that will not be subject to VAT. So you won't have to charge the clients VAT. And obviously the clients would probably prefer that you don't have to make their service 20% more expensive.
Yeah, so that makes more sense now that I know that it's exempt. That is the reason why you would be staying sole trade there, because otherwise, if you do a collective 90,000 or more, then that means that all your prices would have to go up by 20%. And I'm pretty sure that some people would not see that beneficial when, as a sole trader, it is considered exempt. So yeah, that would definitely be the reason why your accountant said that. Thanks for that, John. That was very helpful. So somebody has also asked here, could you explain a little bit about payments on account, please? I didn't get asked for any after my first year. So payments on account, let me just see if I can easily switch this the screen that I am showing. So just flicking over to the HMRC website here on payments on account, and you basically have a certain threshold that you need to meet before you start making payments on account. So in this instance, if your last self-assessment tax bill was less than £1,000, then you wouldn't have to complete payments on account. Or if you've got multiple sources of income and 80% of the tax bill was collected at source, then you also would not fall in payments on account. However, that might happen in your first year if you were previously employed for the majority of the year, or for part of the year and then you became self-employed and you didn't earn as much, and 80% of your tax or more was deducted at source through your employment, then you wouldn't fall in it that year. But then following year, when it's just your private tutoring, and you're no longer employed, or if you've wound down the employment to 1 day a week and you're doing 4 days a week private, then it would be likely that, depending on how much you earn, you will then fall in payments account in the second year. So that is definitely a thing to bear in mind. One thing that I'm saying here, or what I said previously as we were going through, was when you do fall into payments on account, you do need to save more than what I was saying before about the 42% or the 26%, because how it works is, what you will do is you'll work out your tax bill for that tax year specifically. So for 23-24 tax year, which is due by the 31st of January 25, yeah, you would pay your 100% of last year's tax bill. But if you do fall into payments on account, you would then basically pay an extra 50% of that tax bill towards next year on the assumption that you're going to earn the same amount again. HMRC do that on the basis that if it's a consistent business, then you'll be okay. If you earn more profits next year, then you've paid somewhat of the bill and you'll have a balance in payment due on the following 31st of January. But if you are expecting a worse year or you've had a worse year, then you could either make those payments and get a refund when you come to do your tax return, or alternatively, you could look at reducing your payments on account if you know that you're going to have a worse year the following year. So we start looking at this and then we're going, okay, so I've got a 40% tax bill and my profits here, but then I've also need to put an extra 20% away towards next year because, well, I've got payments on account that are going to be due. And then that could also get people in a bit of a mess if it's a very good year first year and it's looking to be the same next year, but you've spent the majority of the money because you weren't expecting to have that sort of money in there. So like I say, it's definitely worthwhile taking into account that if you are in a good year and your tax bill is going to be more than £1,000, less than 80% of your tax is going to be taken at source, you do need to start a sort of plan for payments on account as you go along. I usually say to people, if you're looking at £20,000 of profit, put around about 30% away. If you're looking at £30,000, put about 40% away, and then anything above that, go to 50%. And if you put too much away, then you've got some spare cash, haven't you, after you've paid. If you don't put enough away, then you're scraping around trying to catch up. So it's always better to be planning in advance for that sort of thing. Hopefully that gives you a bit of a understanding on payments on account. It is not the easiest to explain, nor is it the easiest to understand, but I hopefully have done an okay job with that one there. Is anybody else got any questions, or has anybody want me to throw back to any of the slides with the numbers on or anything like that, where I might have rushed through them? I did try and take my time, but I do get carried away a little bit every now and again. But if there's no other questions, then I can wait 30 seconds and I'll just go into the final slide. Or if anyone wants to put anything in there, then be my guest. So a little bit of quiet now, I'll just take a drink and then we may move on to the last slide. Looks to be fairly quiet in the chat, so I am not complaining with that one. Hopefully everyone's understood and not just stood there or sat there at the screen going, what is he on about? So yeah, so just moving on to the next slide, which is just basically saying thank you for attending. If anybody has not signed up to Go Simple Tax, then if you were to type in gosimpletax.com/TTA, you will click on that link, sign up using your email and the password, and following that you'll get a few welcome emails, and one of the welcome emails will be a discount code for 20% off, I believe. So you'll get 20% off the first year, And if you've got any questions, there'll be support on there, of which I sometimes dip into. So if you've got any questions for me direct, then be sure just to put FAO Aiden on there. Or if you've got any questions following this, I'll be there to help. Hopefully that gives you an idea. I mean, it makes sense in my head, but I've got background knowledge, so hopefully it gives. I can see a few people saying thank you, it's relevant informative, so that's good. But again, if you've got any questions following this, be sure to get in touch and we can discuss. Perfect, thank you. I think that's all from me then.
Brilliant. Thank you very much indeed, Aiden. Really, really helpful. I'm sure people found that very useful. Yeah, really appreciate all your insights. I think the upshot is that from a purely tax perspective, the gap between being a limited company and a sole trader really has narrowed.
Yep.
So it doesn't make an enormous difference just purely for tax purposes. Obviously, there are other factors that people might want to bear in mind around that. But thanks very much for the comprehensive overview. Again, if anyone wants to get in touch with Aiden afterwards, he's given you the details there to do that. But thanks very much, Aiden, for joining us for our summer session. And good luck, everyone. And to those of you that are watching this after the event, hope it found it helpful and hope you can make good choices going forwards.
Yeah, thank you for having me as well.
Brilliant. No, thanks so much, Aiden. Really appreciate it. Thanks so much, guys. We're going to stop the recording there and we look forward to seeing you at a future TTA event.